So these are few of the services that we offer, sir. Our primary objective is with regards to wealth management. Our wealth management process is split across into 4 different processes. First, we set up an objective, identify a strategy, implement a strategy, and monitor the direction. So this monitoring the direction is the most important aspect, sir. This is where we interact with our client on a monthly basis just to take their inputs, see if any kind of changes needs to be done in the objective part. Unlike to this, sir, what we used to follow in our previous organization, it was more of a sales approach. One time we used to do a sale with our clients and then get done away with this. But over here, sir, things are much more dynamic. As and when your input changes, we would change the whole output, sir. The next part is tax management. So, sir, what we have is there are certain ways that we can manage the taxes in terms of capital assets. So the capital assets, like what we have is real estate, fixed deposits, real estate, gold, equity, debt, and other investments maybe into derivatives. So these assets, so we can offset the capital gains versus the capital loss, short term versus long term. As in short term can be offset against short-term losses can be offset against short-term gains, whereas long-term can be offset against long-term losses. So there is a way that we can manage the taxes in a far effective way, rather than, say, for example, if the investments are not going well. So we can still take a call and book a loss and adjust, carry forward that losses for the next 7 financial years and offset it against the gain that happens at a later date, sir. So the next part is estate planning. Estate planning is one of the most important parts, sir. Is because if you see in India, there is like say crores and crores of rupees which are lying as a part of unclaimed deposits with the bank, with life insurance corporation, with the security deposits, money lying unclaimed in the demat account. So people are not aware what is their wealth which is spread across in different vehicles. So our idea is to make sure that this wealth that one has generated passed on to the next generation without any loss whatsoever, sir. Then, sir, we have a tie-up with local brokers pan-India, wherein we help them clients to offload their real estate. And in this, sir, we would take the cost incur from your side would be a standard 1% commission, and this can be any location pan-India, sir. Need not be only on the major cities. It can be any locations, because we have done a tie-up with the companies that is present on a pan-India level. Plus, we have done tie-up at a local level also, sir. Then, sir, there is no additional charge that we charge on any of our advisory services. We get our commissions through the investments that you route through us, and this commission is 1% of your investment value, which is paid to us through the fund houses. So there is nothing additional that we charge over and above the money that you're investing with us. Nor, sir, there is any kind of agreement or fee on the future that we would sign with us. The only thing that we are comfortable signing is if you want us to sign a non-disclosure agreement with regards to your financial information being shared, so that we are more comfortable in signing a non-disclosure agreement at any point in time, sir. Apart from that, there is no other account opening document that one has to sign, or any kind of booklet that he has to sign that has a hidden terms and condition, nothing of that sort whatsoever, sir. Then our other support that we have is we have a 54 member product team, and this 54 member product team is split across between analysts, tax expert, legal experts. So these are our support, wherein any client who require any kind of, say, input in making any decision. So these product team would come on a call with us, interact with our client, and help them take that decision, whatever they want, sir. So any questions on this slide, sir?
So yeah, I think for benefit of everybody, I think Anand Rathi is got offices all over India, right? How many offices do you have?
Sir, 11 locations we have our offices,
okay,
sir, in India. Plus, also, sir, for us to reach out and get things done is not a problem, sir.
Okay.
We have been in the market since 2002, and our the average experience what our the relationship manager team has is 8 years plus. So somehow, somewhere, sir, we'll get a contact and try to arrange for the information, whatever that is best possible from our side.
Okay, thanks.
So Nari, they came as a reference from someone to you
Yes,
to
yes.
do. Okay.
Yep.
And you know them personally.
Yeah, yeah. No, yeah, we have good references.
Okay.
So any further on questions on this slide, sir?
So,
No.
is there any one-time charge for the?
Nothing, sir. Sir, no charges, sir, because what we have is the commission that we get from the investments, as in the commission that we get for routing your investment to the fund houses. The fund houses gives us a commission of 1%. Though this 1% might look small today, but this has a multiplier effect once the wealth grows, sir. So there is no additional fee whatsoever from your side, sir.
In terms of decision making, who decides what funds or what stocks one would buy?
Sir, we have a dedicated team in terms of the research. So what happens is, say, let's assume a mutual fund today, what we have is might be doing well. But there is a lot of thought process that goes into selecting a mutual fund depending upon the consistency that mutual fund would give over a period of time, sir. That is one. Second is, sir, as the market is quite dynamic, sir. So today we follow a relative PE model to come across a particular allocation. Now tomorrow this allocation, this relative PE model changes. Then, sir, we would change the allocation. We'll go back to each and every client and change their allocation, sir, which would be a shift between a large cap, mid cap. That is one. Second is with regards to your query on the stock part of it, sir. Again, with the stock part, sir, we have a subsidiary by the name of Anand Rathi Stocks and Sharing Business. So we have dedicated people and a dedicated research team on the equity bit as well, who would guide us to which stocks to buy and which to get out, sir. Plus also, sir, over and above, sir, we to first design the portfolio, sir. We would take your inputs in designing a portfolio is because your risk appetite, what is the time frame, those things are important. So a generic advice in terms of buy this, buy that does not work in a long run, sir.
What's your track record?
One more small question.
Pardon, sir?
One more small question is, do you like ETFs as well in India or only mutual funds?
Sir, what we have is ETFs. I'll explain, sir. So in India, if you see, sir, the ETFs are the least cost structure product that is available in India. But the ETFs are designed in a way that it mirrors the particular index. Now, sir, the ETF will does not have an outperformance compared to the index. Whatever the index has performed, the similar returns would be possible. So if you see, sir, the year till date performance of the Nifty 50 is 25%, sir, as until Friday closing. Whereas, sir, the mutual fund basket that we have, sir, that has given a return of 31.5%, sir.
So if I have a say, can I want to stay only the ETF? Will that be okay for you?
Sir, for me is not a problem at all, sir. My idea is to add value, sir. You can, sir, yeah. Once we set up the platform, you can do whatever you want, sir.
Okay, all right, that's good.
But the idea is to add value, sir, over a period of time. If it makes sense to continue with the ETF, we'll continue with the ETF, sir.
So what do you mean by the real estate sale?
Sir, say for example, on an average, sir, if we talk about in Bangalore, sir, an individual maybe at least would have at least 2 to 3 properties, sir. Now, say somebody today decides to let go of one property because he thinks that the price appreciation, what was in his mind, is not would come through. So, sir, what we have is we have tie-ups with local brokers, sir. These local brokers will find the customers, the buyers for us, and we will introduce this buyer to you. And depending upon what is the price negotiation goes further, this is the sale, the broker will step in and help us execute this deal, sir.
Is this only in Bangalore, or you take care of this in other cities in India also?
Sir, pan India, sir. So there's a company, sir, by the name of India Asset, sir. So this entity is available, is present pan India. So first is, sir, we try to get the contact generated through this particular entity. If that works out very well, sir. If that does not works out, so we contact a local broker in that particular area and then work our way up how to arrange for a buyer, sir, there.
Where do you
commissions for it?
Pardon, sir?
Sorry, go ahead. Someone else.
Pay the tax?
Sir, please could you repeat that?
Tax filing is done in how it is, like how do you pay the taxes?
Sir, on the part of the taxes, so sir, say for example, this tax is getting generated by, let's assume, a sale of a real estate, just for discussion's sake. Now, sir, what happens is with the real estate, so there is an indexation. Say for example, if the property is being held by one individual for more than 3 years, then what happens is there is a rate of indexation that will come in the picture. Now, say let's assume if the purchase price is like say X and the indexation factor is say 0.10, so this rate, the purchase price would get inflated by as in 1.10, sir. So from there minus the sales price would be the actual capital gain that will happen, sir. So if the
actually let's move on, because today's focus is more on mutual funds than real estate. Probably let us keep going.
Yeah.
So one quick question on that end. Can you talk a little bit about your track history in the wealth management area? I mean, you talked about Nifty 50, 25%, and your basket of mutual funds got you 31. But is that a 1 year or an annual basis? What's the track history out there?
This last year and this year has been an exceptional year, sir, wherein there was a huge amount of liquidity that was available, and plus because of the lower interest rate. So this is where the equity was able to deliver this kind of return. But if we talk about the past history since 2014 until now, our mutual fund portfolio or the mutual fund basket that we have, a CH, on a compounded annual growth rate, it has delivered 14.5% return, sir.
14.5.
14.5. Whereas the Nifty's annualized return that we have has been so close to 12.5%, sir.
Yeah.
So our overall objective, sir, with the mutual fund performance or the mutual fund selection and managing the whole basket is to have at least say 3% outperformance compared to what the market can deliver, sir.
Yeah.
So in a year, sir, at times, sir, we have been able to deliver just 1.5% higher than what the Nifty has delivered. In a year, sir, we have been able to deliver say close to 3%. So this year, sir, till now, sir, we have been able to outperform by close to 6%, sir.
Well, so when you look at the risk associated with that, what is the risk and volatility that you compare yourself against out there?
So, sir, what we have is we measure risk through standard deviation, sir. So our whole endeavor is say the Nifty standard deviation, if it is say 18, but so our whole selection process or the fund selection is that put together the basket of this particular fund should have a lower standard deviation what the Nifty is.
So you're getting a lower standard deviation, but you're getting a higher return. So you're saying you have lower risk but higher return.
Yes.
Interesting. Okay.
So reason being, sir, what we have is every investor have an option today to invest into a direct fund, sir. By investing into a direct fund, what he does, he saves 1% commission that what he is paying on a regular fund, sir. So any fund that one invests through a broker, sir, like say in this case, Anand Rathi is a broker. So he ends up paying 1% as a commission. But the value that we bring in for this particular commission that you are paying is to have a lower, better risk management and a higher delivery in terms of what the market can deliver, sir.
Okay. Okay, continue.
Sir, next is this investment route, sir. So currently, sir, for non-residents investing in India, there are a lot of restrictions, sir. So they can invest into few limited funds from their NRI, NRO accounts, sir. And if it is a NRI, which is a non-resident external account, the money can be transferred from an overseas account. It will come into this account and they can invest into few of the options that is available. And once they liquidate, the money comes back to the NRE account. And this money that comes back, it is 100% repatriable. Similarly, sir, if anyone has some income that is generating in India, like say rentals or any other income, so they can invest the money from this NRO account into these funds which are available. And once they bring, as in liquidate this investment, the money comes back to the NRO account. And using a chart, as in through a chartered accountant, sir, we would require, as in the banks would require a 15 CACB certificate. This certificate talks about that taxes has been paid on this particular money that has come in the NRO account, and the same money can be repatriated whenever you want, sir.
And the gains on the NRE investments, are they also subject to the same capital gains?
Sir, I will talk about the tax part on the next slide, sir.
Okay.
A better route is there is by having a private family trust. Now, sir, what the private family trust gives you is you do not have any restriction of investment, sir. Like how a non-resident he can only invest into few of the funds, whereas we get an advantage of a level playing field wherein you can invest into anything that is available in the country. And also, sir, you can leave and whatever the income that gets generated out of these investments, so you'll not be paying your global taxes on this particular part, is because a private family trust would have a separate PAN card and a separate bank account, sir.
And is the funds repatriable in the trust, or is that trust irrevocable trust?
No, sir. Sir, what we have is on this part. So whenever we create a trust, so there are certain beneficiaries that we would create. Like say husband, wife, and children. So now, say for example, on this, so there are 3 beneficiaries. So the money will move out from this account of the trust account and will only go to this particular beneficiary. And from there, sir, also, sir, what we have is the taxation that works on a private family trust is not on the overall income that it generates. It is only on the capital assets. Let's assume if it is on an equity mutual funds, on a long-term basis, sir, 10% is the capital gains that the private family, as in that particular investment, would pay. If it is on a debt non-equity base, sir, depending upon when we are liquidating, say before 3 years, after 3 years, that point of time the taxes would be generated depending upon what asset class that we are investing into, sir.
I have a question here.
Does your organization help to set up this trust?
Yes, absolutely, sir.
Okay.
Sir, we have a dedicated legal team, sir. So because sir, say for example, I would have a different family structure compared to say my other colleagues. So this part, sir, we would like to say discuss in more details and have a better clarity on how to go about this part. But with regards to forming the trust deed, from applying to the PAN card, in getting say for example, if you have an existing banker in India, through him, if you want to open the trust account, we can do that. Or if you want our channel to help you out, we can do that also, sir.
Okay.
But once it goes into the trust fund, does that trust basically is repatriable funds, or is it not repatriable?
Sir, it is repatriable, but sir, what we have is from trust directly, we cannot repatriate it overseas, sir.
Okay, but because it has now moved from the NRE account into a trust, which basically now becomes a fund that's going to be regarded more like an NRO, I would assume.
No, sir. So this would be treated as an Indian entity. So I will talk brief about the trust as well, sir, or in a later slide, sir.
Okay.
Mr. Mishra, one question regarding the NRO investments. It appears to be there are some restrictions on certain equities are not allowed by RBI to buy.
Yes, absolutely, sir.
So only you have to always, before you purchase any equity on even ETF or mutual fund,
yes,
RBI makes a restriction on this, what you can buy, what you cannot buy.
Yes. Also, sir, what we have is there is a declaration that needs to be given when we are purchasing the investments, sir, or doing the investments.
Okay. Okay.
So Soumitra, that's the question I asked on the chat, right? So is there more scope here? For example, if you take ICICI and you go into them and ask them, there's a lot of restrictions, right?
Yes.
As an NRI.
Yes.
So is there more scope here because of something else, or what's the deal?
Sir, in terms of you're referring to the private family trust, or you're saying?
No. I'm talking about from an NRO account, right? There are so many choices. When you look at the internet, there's so many choices, but then as an NRI, you're restricted to only a few.
Yes.
So that restriction will still apply here too, right?
Yeah.
Yes,
through
absolutely, sir.
Anandrati.
Yes, yes.
Okay.
Sir, what we have is currently, if you see, there are close to 461 open-ended mutual funds that is available in the country. But for an NRI, sir, he can only invest into, like, say, 50 of them, sir.
Right. Okay.
Sir, the idea is we would like to have a further discussion depending upon what your choice of investment is. If, say, for example, you are more keen investing into say a Nifty based fund, which a lower options are available, so we can go ahead with that. But if you are looking for a bigger option of, say, investment route, a private family trust would be probably a better option, sir.
Got it. Okay. Yeah, we can delve into details later. Okay. Thanks.
Sir, this is the taxation which is applicable. Now, say for non-resident Indian, there is a TDS which is applicable, tax deducted as source on the capital gain. So in terms of equity, sir, if it is a short-term capital gain, 15% on the capital gain, a TDS, the fund house will deduct and report it to the income tax. Similarly, sir, on a non-equity based, on a short term, which is less than 36 months, the fund house will deduct a 30% TDS and report it to the income tax. Now, compared to that, sir, on the long term, sir, what we have is 10% and 20%. We get the benefit of indexation. Now, sir, with regards to if you find that, as in make the investments on a non-resident route, so what happens is, sir, there is a taxation agreement between US and India, sir. So if you are paying any taxes in the country, you can actually settle it against the taxes in the US, sir, vice versa.
So this comes into picture for mutual funds only when you close the mutual fund, right?
Yes.
Okay.
So as long as we are holding the mutual fund, sir, so there will be no capital gains or no issue of tax filing, sir, in the country.
Okay.
Also, sir, what we have is these days the tax filing has become very easy, sir. It is just more of a as in if you have to file the taxes in India with regards to, say, the trust account. So the filing of the taxes has become very simple, as good as, say, juggling through an application, sir.
Okay.
Typically, maybe we'll cover it later on. What is the typical cost of a mutual fund per year, annual, NER?
So, sir, if you talk about the expense ratio, sir, on an expense ratio basis, the average mutual fund cost would be, say, in the range of between 1.25 to 1.9 or 1.8, sir.
Okay. And initial cost?
No initial cost whatsoever, sir.
Okay, thank you.
Sir, earlier there was a concept of an entry load, sir. So those things have been taken away since 2014, 2015, sir.
Yeah, I have suffered through. They charge me 15%.
So today, sir, there is no entry load, sir, but there is a concept of exit load. So there are funds which charges an exit load if you step out of the mutual fund before 12 months, sir.
Okay.
So one quick question, Soumitra, on this long-term gains for the equity versus non-equity, is that 1 year or 3 year timeline for long-term classification?
Sir, for equity it is 12 months, sir, and for non-equity it is 36 months, sir.
Okay, and then the other question is in terms of the capital gains. So let's say I'm in a fund and the fund is invested in, say, 50 stocks. They trade in and out of the stock, like in the US, that is kind of, that capital gains gets accrued to us. Is that the case, or is that when you sell when you actually liquidate the fund, are you treated as capital gains? Because
sir, when we liquidate the investment, then we are treated with the capital gain, sir. As long as you are staying invested, there is no capital gain. Sir, the one that you are referring, so it is slightly different. So there is a concept of a portfolio management services. So in that, if you say the fund houses makes any changes, a capital gain is taxed to you, sir, in a portfolio management services. But whereas in a mutual fund, sir, there is no concept of this capital gain happening is brought back to your tax in that current year, sir. It only is applicable when we liquidate the investment. Till that point in time, sir, we need not worry about any kind of taxation whatsoever.
Okay, because that's different. In the US, whatever happens within the fund, also that trading, you get like a capital gain reporting to you. So I think there's that difference between India and here, I guess.
I think what happens typically in the case of mutual fund, if I am correct, that if the mutual fund manager either buys, sells within the fund also, that capital gain is declared for you. Losses are not, but capital gains are declared for you.
No, sir. No, sir.
But whereas when you sell, of course, that is your capital gain or loss, but only for within the mutual fund, if the money manager buys and sells, that capital gain is, as Mr. Narang is saying, is probably passed on to you.
No,
this
sir.
happens
Sir,
in Canada as well.
Sir, what we have is those fund houses have been exempted from these recurring capital gains. Is because they come under the domestic institutional investor, so they are allowed to run the as in the do the buying and selling of the basket of the funds and incur a capital gain or a loss at the end of the year, sir.
Yeah, at the end of the year, yes.
Anji.
And they do declare to you that they have made purchases,
Yes.
and either they have got either distributions or the capital gain that is reported in your tax.
So these
even though
days,
you did not sell it.
Yes, yes, absolutely, sir. But for an
One
investor,
more
sir,
thing. Yeah, sorry.
So for an investor, sir, he need not worry about whatever the fund house has made gain losses, that is brought to the investor. It is not like that, sir. He will only be charged when he is stepping out of the investment.
Okay. One last thing is, last year in 2020 or 2021, that is, in the past, I have one particular fund which is I have purchased for last 25 years. So till then, it was NRI investment, and the dividends were tax free for us.
Yes.
In last year, I suddenly got loaded with 30% of dividend tax TDS. So is there something which can be, is it correctly understood, or some can explain on that?
Sir, what we have is as you have purchased a fund, say maybe 20 years ago. So whatever the so the dividend distribution tax came in last year, sir, in India. So anything that was as in the retrospective part, so we need not worry about the taxes there, sir. So the one that is happening from after the tax bit has come in, so from there the liability starts, sir.
So basically what I'm saying, earlier, I didn't have any tax in India, but I had to declare it my Canadian income.
Yes.
Now, I paid TDS there, then I have to claim because I paid TDS, and then some more information has to be given to Canadian authorities that I have paid tax, and I don't know how that works very well. I have not tried that.
So, sir, in your case, sir, what we have is as there is a dividend that has got generated, so there is a dividend distribution tax that would be applicable. So this dividend
even for NRIs, even for NRIs,
sir. So this will be showing an outstanding against in your income tax in the Indian PAN card. That so much income has been generated. So in your case, sir, what we have is we have to file the taxes, and in case, say for example, if the dividend amount is more than 10,000 rupees, then sir we have
a big amount. I had a big amount of dividend.
So there, sir, we have to pay some taxes in the country, and then, sir, you can offset this in your country that so much of the taxes have been paid when you are taking this money back in the country, sir.
Okay, all right, go ahead.
A question: is a demat account required to trade?
Sir, for investment into mutual fund, no demat accounts are required, sir.
And what about individual stocks?
Sir, for individual stocks, demat account is required, sir.
Yeah, okay. So you can set it up and all that, right?
Sir, we can set it up, absolutely, sir. Sir, we'll handle everything, sir. Once you tell us what is your requirement basis, what you want to invest. Accordingly, sir, we can help you out end to end. Would not be a problem at all, sir.
And if I already have a demat account, can that be used?
Sir, you can use it, sir. There is no problem whatsoever. But sir, if the demat account is with us, it helps in a lot of ways in managing the capital gains, sir.
Yeah. Okay.
What are
Somnath, can I, this is the thing about, just to clarify on the double taxation relief, which Soumitra was mentioning. It is many times, I'm talking from the Canadian perspective, many times it may or may not be one-to-one. Suppose if you pay the equivalent of, let's say, $10,000 in India, when you file your return in Canada, you may or may not get the $10,000 relief, because there is a way in which it is calculated. It's a long calculation. I don't want to go into the detail, but the relief may not be one-to-one.
Yes.
I just want you to be aware. You may already be aware of it, but just to make it clear. that it may not be one-to-one. Soumitra, I got a question for you.
Please,
For
sir.
individual stocks in India, you know, we need a demat account,
Yes.
but we also need a trading account for dealing in
Executive.
shares, right?
Yes. Yes.
Or particularly for selling.
Yes.
And that documentation is slightly different compared to opening a demat account. My understanding is opening a demat account is easier, whereas getting a trading account opened requires more documentation and including an Indian address for which you require some proof, like a local driver's license and a couple of other things. So am I correct?
Sir, I will tell you, sir. So, sir, what happens these days, sir, the companies, they open both these accounts in one go. So the demat account is basically a holding account for all your securities that you purchase. So the demat account is just a holding account and the trading account is a transacting account. So any buy and sell happens through this transacting account. Now, these days, sir, the documents have become simple. Earlier, sir, maybe a few years back, an individual has to give at least like 45 to 50 signatures across different, as in a thick booklet, sir. Now that has come down to say close to 18 odd signatures that include both, sir, the demat as well as the trading account. And sir, with reference to your the documentation part, yes, there is an overseas address which is required and a local address required. But in case, say, for example, individual does not have, we can always look at working it out how to arrange for the other part, sir. Which is
the reason I was asking is I went through a lot of difficulty. Maybe it's not applicable now. As late as about 2 years or 3 years back, because mainly it is to give you the local address for which the broker requires, at least in my case, required a ID, which says that, which proves the local address. And the ID that were acceptable were only 3 or 4. One is a local driver's license. The second one is an Aadhaar card. And third one is a bank passbook showing the local address. And the bank will not put the local address there unless they get the Aadhaar card or a driver's license. And none of these documents, most of the, for example, I didn't have any of those documents. I don't have a local Indian license. I don't have an Aadhaar card. So it was a lot of difficulty, and how it was resolved, I don't want to go into that. I mean, nothing on an illegal side, but it was not easy. That's what, you know, I wanted to mention so that everybody is aware. If it is still prevalent, it's one thing, but if it has been eased, that's well and good.
Sir,
Soumitra, Govind mentioned this complexity. I think that is only applicable if you trade in individual stocks, right? So it will not be applicable to just the mutual funds with you, right?
Yes, sir. So this would not be applicable with the mutual fund part, but in case, sir, there is any complexity with regards to arranging a document, sir, what we have is we have been in this industry for a long time, sir. Now, we would not ask you to do a running around. The idea is we would ask your support in getting things arranged, but we will give you the input how to get these things done, sir, one after the other.
Yeah. So I think these are all very good questions. So why don't we let Soumitra finish his presentation and then we can keep asking him questions after that. Okay, go ahead, Soumitra.
Sir, this is the taxation which is applicable on a trust, sir. So the trust has a similar taxation what a resident individual will have. So a long term would be 10% for equity, and for non-equity, sir, it will be 20% with the indexation. Short term would be less than 12 months, and long term, in case of non-equity, it would be 36 months. Whereas for equity, it would be 12 months, debt is 36 months, sir. So it is treated as an individual, sir. And the best part is, in case, say, for example, any individual who is a resident Indian earning a higher salary. So if he routes his investments through a trust, he ends up paying a lower surcharge on the capital gains that happens, sir. It's because in India, sir, for a higher tax bracket, people who are earning more than 1 CR of an income annually, they pay a surcharge of close to 40%. So
these trusts are those Hindu undivided family kind of entities, or these are separate trusts?
So these are private family trusts, sir. So the Hindu undivided families is the HUF concept. So that is a separate thing, sir, wherein the investments are held by, say, the individual and his family. But this has nothing to do with that, sir.
Okay, just wanted to confirm that.
So, sir, the working of a trust is very simple, but sir, the complexity of the structure, I would like to take it in a more detailed session, sir, so that we can answer all your queries and explain you all the legalities, sir.
So is the main benefit of the family trust then is that there's no TDS you have to like kind of worry about, but then the TDS is so like no TDS at the liquidation event, and the second thing is that if you are earning, if your personal tax ID is in like very high tax bracket in India, then you have a benefit of the lower tax there. Otherwise, for like most of us, since we are not like high earners in India probably, so that benefit doesn't apply to us.
Sir. But sir, the other part of it, sir, you are part of the global taxes, sir. And if you see, your taxes are much higher than what we have in India, sir.
Yeah.
So still you get a far better advantage in terms of taxation on your capital gains. So sir, what we have is it actually gives us an opportunity wherein it opens up the field for us that we can invest into anything through the trust, sir. Even buy a real estate through a trust is as simple, sir.
Yeah.
I presume you'll
cover. I didn't
understand the part that trust later on.
Pardon, sir?
The cost of the trust itself, that will be covered later on, maybe.
Sir, the cost of the trust, I'll tell you, sir, right away, sir. The cost of the trust of setting up a trust would not be more than 25 to 30,000 rupees, 30,000 Indian rupees, sir.
Okay.
So, and that too, this is a one-type setup cost, sir, with regards to registration, setting up the PAN card, everything, sir. I'm just saying this is on the higher side, sir. If you do not want to get it registered, I'm sure, sir, we would end up paying only a few thousand, sir.
And what about recurring?
No recurring, sir. Nothing, sir. One-time setup, sir.
Okay.
So I didn't understand the second part, the one that you explained, that there's a advantage of the tax advantage for the overseas people.
Currently, sir, what we have is the way one is, sir, you have to say, for example, today, if says anyone is part of the global taxes, he has to report his income in the overseas. Let's assume that you have an investments running in India and you are working out of the US. So whatever the investment value that today is as on 31st of December, you have to report everything in your income tax.
Yep, we do.
Right, sir. That is one. Second is, sir, now say for example, as sir was talking about that, whatever the TDS that you are paying over here when you want to say claim the benefit, so there is a currency rate that comes in the picture, sir. So because of which, whatever the taxes that you pay in the country, you do not end up claiming the same amount of money. So what happens is when you route your investment through the trust, it bifurcates you. Trust is a separate entity and you are a separate entity. So it has no linkage with you regards to your taxation.
Okay, so in the US FBAR or the 8890, then I don't have to like report the content or the
absolutely
deposit. Okay.
Yes.
So basically, you're saying all the income made in the trust is not taxable in the US. You only pay local taxes there for the trust, which is a lower rate, right?
Yes, absolutely, sir.
Only when you will liquidate the trust, that time you have to pay.
Yes.
No, so when you liquidate the trust, the trust liquidation goes to your local NRO account then, right? Or the NRI account. And then from there, you bring it back to US. At that point, what's the tax implication at that point?
No, sir. Sir, what we have is, one is, sir, if you have family members in India, we can still get away with the taxes part altogether because you can route it back to US as a part of gift. So you do not incur any taxes there, sir.
Yeah. Is there like a gift limit on that one? Actually, that's a good question.
No, sir. No, sir. Sir, in a year, sir, you can take equivalent of as in today, sir, close to 2 million.
Yeah.
Oh, wow. Okay.
And sir, also you can stagger it, sir. Like say for other clients, that what we do is like say 31st, but before the end of financial year, we take some, and then after that we take some, sir. So we split that amount, and in case if it is a higher sum of money that needs to be taken away, sir.
Interesting.
Sir, there is a bigger advantage that we have is the trust actually provides you a ring fencing on your wealth. Let's assume tomorrow there is any liability that incurs on one individual. So whatever the assets that one hold under his current name, so that all the that assets would go towards funding that liability. But if your assets are put across in a private family trust, so it has no linkage with the individual, and this particular wealth would be treated out of his individual capacity, and the liability would not incur on this trust wealth.
And the beneficiaries of the trust will then have to be your family members in the India,
sir,
like the parents from that.
Exactly. So the beneficiary would be, sir, your family, whomsoever you wants to keep. And also, sir, we put it as a non-discretionary, as in we do not specify how much is the percentage what one gets, sir. So if we specify the percentage, then, sir, the liability comes back to you. So we do not specify what is the percentage that ones get. We only specify that these are the beneficiary 1, 2, 3. So what happens is, the advantage is, in case any liability incurs on the individual, this trust money does not go towards funding that liability.
But can you still be a beneficiary of the trust, or can it only be like your relatives without you?
Sir, we can work it out depending upon your family members. How are they? Depending upon your family members, your family structure. One way, sir, we can do it like, say, we can say, if you want to keep, we can only make you as the trustee and your family members as the beneficiary. So you can route the money back to the US via your family members, and from there you can route it to the accounts.
Yeah, I think we had enough questions on trust. I think we can have a separate on trust. Let's move on.
Sir, this is the fund transfer route, sir, from overseas account. So these days, sir, the transfer of money, you can bring in the money in the country as a part of maintenance self, and it takes 1 working day. And vice versa, sir, there is no tax implication on the wire transfer in any ways. Similarly, sir, the wire transfer works on a trust account, sir. It can be transferred directly from your account to the trust account, or it can be routed through any of the family members' accounts, sir. Again, the route is very simple, sir. But if you directly, sir, there is a thing, sir, if you directly route the money from the overseas account to the trust account as a part of the gift, then, sir, we would be charged as a gift tax. So that we will help you with the inputs at time to time, depending upon how you're bringing in the money. So, any questions on this slide, sir?
Gift tax in India or the gift tax in the US?
So tax in the US, sir. So there's a gift tax concept in the US, sir.
Yeah.
So what about the other way around, from trust account to overseas account? That is not possible, right?
Sir, very much possible, sir. So what we do is, like, we move the money from your trust account to one of the family members, and from there, sir, we do a remittance account.
Correct. No, it's not. I mean, I'm saying you cannot directly transfer.
No, sir. So the trust does not have the remittance benefit, sir.
Yeah, correct.
Sir, it's just that, sir, the biggest advantage that the trust provides is, so there are beneficiaries mentioned in the trust. So in case there is any wrong that has happened, sir, it can be brought under the law, sir, that it has gone to a wrong beneficiary, sir.
Okay.
Because everything would be stated in the bylaws of the trust, sir. Everything would be clearly laid out in terms of black and white in part of the trust.
So what are the tax liabilities for the beneficiaries?
Sir, tax liabilities for the beneficiaries in India or in the in overseas, sir?
In India, because if you're doing it with a family member out there, when a trust is going to provide remittance of funds to the beneficiary, there has to be some tax liability out there, no?
No, sir. Zero, sir.
Interesting. Okay.
So when you say family members, which family members?
Sir, this is where, sir, we would like to know the structure, sir. How?
Yeah, I think that is more suitable for one-on-one. Let's move on.
Let's move on. Yeah.
Sir, these are the simple documents if one wants to establish the platform for setting up purchase of the mutual fund, sir. And these are, like, say, all soft copies of these documents will work, sir. No physical copy required in whatsoever ways.
On to my question.
This is only for the mutual fund, sir.
No, let me ask. My question was that when you say family members in India, here your trustees can be only your own children. It cannot be your brothers, sisters, or any uncle or anybody.
Yes.
So when you say family members in India, what are those family members? Because none of us, I am sure, whose children live there. Our children are all here. So how can our family members be a trustee there?
Okay, sir. Now, say, for example, in this case, say if you do not have any family members in India, so in your case, sir,
we have other members.
Right, sir. So, sir, in this case, I'll tell you, sir. So, what we have is we just need one particular family member or a far-off relative or any individual who can come as a trustee, sir. But the second trustee does not have any say whatsoever in running the trust. That is one. Second is now, say for example, say let's assume that you do not have anybody to route this money out from the trust to your other account. So the money can move out of the trust account to a beneficiary account in their NRO account, and from there it gets a 15 CSCB will come in the picture, and from there the remittance will happen, sir.
You mean nomination?
Okay.
No, sir. Sir, not nominee, sir. Say, for example, the beneficiary, let's assume, sir, your spouse, she has an account in India as an NRO account.
Yeah, I think we are good with trust. I think we might have a separate session on that. Let's move on.
Sir, these are few of the, if you see, sir, this particular thing, these are few of the equity related products which are available in the country, sir. So basis these 5 parameters are the first block, the top block. So we have we use this as a product distribution model, wherein if you see, sir, last the Nifty 50 returns for the last 20 years, sir, has given a compounded annual growth rate of 12.9%. So our endeavor in selecting the product is that the product should deliver returns of which is higher than the Nifty basket. Second, sir, is that the risk that what the product has, it should be lower than what the Nifty risk is. Third parameter is, sir, cost per ERR. By ERR, what we mean is the expected rate of return. So how much is the cost that goes towards generating a certain amount of return, sir? So that is also an important parameter. Next is liquidity, sir, that the product should be have liquidity at any point in time. And next is the taxation, sir. It should not be more than 20%. So if you see, sir, what we have done is we have passed on, used 5 different filters to identify which is the best product to suit one's requirements, sir. So there are only 2 particular products that comes out of this particular filter. Is one is the equity mutual fund, and one is a market linked debenture, sir. Rest everything, if you see, sir, there is something or the other, it gets filtered out.
What is the AIF?
Sir, AIF means is an alternate investment fund, sir. So anything which is on an unlisted basket, sir, is put into an AIF platform. So be it a pre-IPO companies which are not yet listed, so that will be come into an AIF basket if one wants to purchase. So the fund manager, what he does is he would make a portfolio wherein some portion of the unlisted shares would be part of the alternate investment fund portfolio.
And what is PMS?
So PMS is a portfolio management services wherein an individual signs up with a company with a power of attorney. The company would do the buying and selling of the equity and manage the whole performance of the fund, sir.
One more thing is these are the actual returns. If you subtract the inflation, what is the net? What will be the real rate of return?
Okay.
So, sir, what we have is the real rate of return. Sir, what we have is with the inflation part, sir, it is a thing which is not constant, sir. It keeps on moving.
I understand. But today, look at today.
So today, sir, if we have to talk about, sir, the sir, close to 11%, sir, minus the inflation.
Inflation minus, sorry, 11% minus inflation.
No, sir. Sir, if you net off inflation, this is 11%, sir. If you subtract inflation from the real rate of return expected out of equity basket, it would be 11%.
So for a return of 15%,
no, sir, not return of 15%. Sir, with today's market, sir, we are in a high inflationary zone, sir. So the real rate of inflation would be close to 7%. But with the liquidity, the earnings per share improvement on the Nifty basket, an average expectation of 18% is very much acceptable, sir. So minus that, close to 11% would be the real rate of return.
18 minus 7 is 11. That's what he's saying.
Okay, good.
Soumitra, what is the actual cost here? You mentioned it should not be more than 15%. You actually hit 15%. In other words, if your return is 31%, are you actually looking at around 4% cost?
Sir, this is at a cost per ERR, sir. So we divide the cost by the expected rate of return. So if you see the cost, what we have is across these products, sir. On the mutual fund basket, it is 1.9%, sir.
Okay, so that includes like the management fee and
commission, everything,
expense
sir.
ratio.
Everything. So this 1.9% is the expense ratio. It includes the broker commission. It includes the marketing cost. It includes the distribution cost, managing the show end to end, sir, on the mutual fund side of it. So the investor need not pay anything extra apart from this 1.9%, sir.
So the 1.9 includes your commission as well?
Everything, sir. Yes.
Oh, okay. So basically 1%
return,
is mutual fund and 1% is you, basically.
Yes.
Yeah.
And the return numbers that you mentioned are net of these costs, or are they before the cost?
Sir, this includes everything, sir. The cost is inclusive in this 18%, sir.
Okay.
But this is after deducting
after cost.
This is after cost, sir.
All right, thanks.
Sir, any questions on this slide, sir?
So what you're saying is basically Anand Rathi is focusing on equity mutual funds and market linked debentures. So that is what you are saying, equity and non-equity, right? So market linked debenture, will it be classified as equity or non-equity for the long-term taxation purpose?
So this will be treated as a non-equity, and say we get an indexation benefit after 3 years, sir. So if say one tends to stay invested in a market linked debenture for more than 3 years, then there is an indexation benefit.
It won't qualify for the capital gain.
No, sir. It will qualify for the capital gain, but sir, the capital gain would be say close to 10%. Because the rate of indexation will come in the picture, sir. So indexation factor would be close to 10%, sir, and 20% on the overall capital gain. So net of the indexation, it will be close to 10%. So it is far more effective if one stays invested for 3 years and beyond. But if he wants to get out of it, sir, getting out of any of these our portfolio products will take only at max by 3 working days.
Okay. So let us talk about this equity mutual funds, right? So you said around 450 or 500 mutual funds are there, and you have selected, sorry, for NREs only 50 are allowed. And within those 50, do you use the same logic to select the mutual funds?
No, sir. Sir, what we have is on this, sir, as there is a restriction, is because this is where we want to know how much is the risk appetite, what is their tenure, and what is their other set of investment. So basis this, sir, we will structure. If they wants to go only with the non-resident route, NRE, NRO, then sir, whatever the basket that is available, best basket we will set up the fund, is because there are
that is based on the individual risk profile. Okay, perfect.
Yes. So this part we cannot standardize because, sir, for US client there's a restriction. For say other as in country clients, there are say restrictions are say very not that much, sir.
US and Canada are in different category.
Yes, sir. So for US and Canada, sir, we have a standard portfolio, sir. But these are these are more a large cap based portfolio, sir.
Okay. So out of those 50 you said which are allowed for NRIs, how many are eligible for US and Canada?
Sir, say close to, if you see the best performing fund, maybe say 7-8 of them, sir.
Okay. So our choices are limited because I think most of these people in this group are either US or Canada, right? So did we get a slide on what is the portfolio for US and Canada?
No, sir. Sir, what we have is we wanted to explore a few options, sir, and then, sir, standardize this at a later date, sir.
Okay.
But
and are there any funds for the SaaS market in India is expected to grow a lot? Is there any ETFs or mutual funds focused on that, SaaS?
No, sir. Sir, what we have is on this SaaS based thing that you're talking about. There are very few listed players who are in this particular line of business. Mostly it is on the unlisted space, so there is nothing exclusive. But if you talk about, sir, few companies like say Tata, LXC, TCS, they are coming into it, sir.
So is there any other, like, do you have exposure to any like angel investing, like, or anything like that in the SaaS space?
No, sir. Sir, this will come under a private equity platform, sir, which will be part of the AIF, sir. Sir, because these
Part
are
of what? AIF.
this will, sir, because these kind of opportunities exist from time to time, and sir, this will be for a very limited option, sir. So this cannot be part of a generic ongoing fund ever, sir.
Okay. So can you talk about the market linked debenture and compare it with the mutual fund? And how these two
Sir,
work?
I will come
how
on the market link debenture little late, sir, on the slide. There is a slide, not a slide, but
very good.
Some more information.
One second. So the restriction that you guys talked about can be overcome if you're willing to set up that trust, right?
Yes, absolutely, sir. Sir, once you set up a trust, sir,
the setup cost, one-time setup cost.
Pardon, sir?
As long as you're okay with the one-time setup cost, that will open up the limitation to any funds, correct?
Yes, absolutely, sir.
Okay.
Sir, also what we have is, if you see this wealth management, this is a long-term thing, sir. Liquidity, yes, there is a requirement which is available. So there is a way that the money can be arranged to you in the least possible time. But with regards to long-term wealth creation, sir, thing is, sir, it has to be managed far effectively, because whatever the wealth that we are growing, if there is a tax bit that is coming out of it, so it is actually reducing its potential to grow, sir.
Just one thing on the trust. I know, like, Mary doesn't want to talk about that too much, but in the FBAR in the US, you have to declare even those accounts on which you have this, like, the signatory authority.
So, sir, what happens
does
is,
it mean that
coming to it, sir. So now, sir, what we have is there is an option that you have to report the that you are part of so and so trust. Yes, reporting is there, but you need not pay any kind of taxes on the assets that are accrued as on 31st of December.
Yeah. So trust, I don't want to talk about it. Means I said we will have a separate session, because it looks like that is more complex.
Good idea.
So let us because we already have we have very few slides left, but we have very little time left. So let us focus on today, rest of the time on understanding their mutual funds and debenture offerings.
So between the two circled ones, even though the risk is high with the equity mutual fund, you're saying the leaning will be based on the risk tolerance of the person who's investing that you choose? So the return cost by ERR is almost same, 10.5 and 10, correct?
Yes. So, sir, what happens is, now say today, sir, say today, sir, I am at an age wherein, sir, I have a certain risk appetite. Now tomorrow, sir, few years down the line, my risk appetite would not be the same. So this is where, sir, what we do is we mix and match in the allocation, sir. Say bring in a lower equity part and more debt part, sir.
Okay.
So depending upon what your risk profile is, we will change the equity and debt allocations accordingly.
Thank you.
Yeah, I see here the cost column, it goes from 0.5% to 4%, or 4 point something also, 4%. That is sometimes scary.
Sir, this 0.5 what we have put across, this is a standard brokerage in terms of buying a direct equity. But these days, sir, there are platforms which startups like, say, Zerodha in India, they offer a flat fee of 20 rupees per transaction, sir, irrespective of the value of the transaction.
This is annual cost, right? What is cost column that you showed here?
Yes, sir, these are transaction costs, sir. Say, let's assume that one has to buy today an X amount, say equivalent of X amount of money. So 0.5% of that value will go as a part of the brokerage.
No, I think Soumitra, his question was general, right? See, I think it varies. 1.9% for equity mutual funds is an annual cost.
Yes.
Whereas 0.5% for direct equity stocks is transactional costs.
Yes.
So,
but sir, if you actually equate it on a, say, on the, sir, correct, sorry, yes, correct, sir.
Yeah.
So,
okay,
sir,
let's move to the next slide.
Let's move.
Sir, similarly, sir, on this is the set of product, the same, similar set of filters that we use on the debt or a non-equity based product. So in this, sir, there is a concept of a modified duration. So this modified duration, what it talks about is, it say for example, today one is stepping into a particular product. So that non-equity based portfolio, what is the remaining tenure of maturity of these papers or the portfolio of this particular product. So depending upon that, sir, it has a sensitivity towards the increase or decrease in the interest rate, sir. So our basket of the debt product that we come, or the debt mutual fund, is that modified duration should not be more than 4, because any increase in because of the increase or decrease in the interest rate, there will be a movement in the price of those debt portfolio. So we factor in that thing very, as in that is also a very important factor in our portfolio, sir. It is not that today we invest the money and we just forget it. Not like that, sir. We would actually come and see in case there is any change in the portfolio that the fund manager is doing. We will come back and inform you about those changes, and depending upon your input, we would make the changes in the portfolio. So there are only 2 sets of products in India, sir, that actually matches the benchmark. One is the debt mutual fund and one is a provident fund. So, sir, in your case, the provident fund is out, the debt mutual fund stays in the picture in your case.
So for NRIs, are they allowed to participate in everything? I mean, not obviously provident fund and stuff.
Haji.
Yeah.
Sir, if we go with the this trust route, sir, then sir, we can invest into anything barring out this provident fund. But alone, if you want to just without going the trust route, sir, we can invest into few of the debt mutual funds.
Right. But if you, I mean, if you have a bank account, you can do fixed deposit also.
Also, yes, right? Yes.
Yeah. Okay.
Sir, this particular slide talks about if, say, somebody would have just put the money, sir, without giving any thought process in the year 1995, he would have just invested, say, an equal distribution of money across these 10 different funds. So this slide actually talks about that the mutual fund has a potential of delivering a higher return than what the index can give. That is one. And on a long term, sir, this has a far bigger impact through the power of compounding and creating a real wealth in a longer period of time, sir.
Yeah, Mr. Viswas, one point which we all have to understand, at least people like me who are all 70 plus. So the time horizon available is not necessarily what normally investment product should have. Yes. Like you said, 25 years, 30 years. Yes. So if we can manage next 10 years, that's what we can, I can confidently say I can target for that.
Sir, one thing I'll just try to bring to your notice, sir. Now, say, for example, if you're able to compound the wealth by, say, 15% per annum, so we can quadruple the wealth, sir. Whatever that that you're putting. I'm just saying at just 15%, sir, it can become 4x, sir. So also, sir, what we have is for an individual, sir, to consume whatever the wealth that he has, it's probably not possible, sir, in his lifetime. Generally, sir, what happens, it is passed on to the next generation, sir.
Yeah. Okay, we'll talk about more.
Sir, any questions on this slide, sir?
Yeah, well, the only thing, when you say 10 years, the return is about 8%. Then over 10 years, at the most, you can double.
Sir, yes.
With the compounding.
No, sir, this particular funds, these were the only funds that were available, or the bigger funds which are available in 1995. But if you see, sir, there are a lot of regulatory changes that has happened since then, and now there are a lot of new companies which have stepped in. There are a lot of transparency regulations. A lot of things have come in today, sir. So these days, if you talk about, sir, today, the fund manager's variable pay is linked to his particular fund, sir, which is managing.
So what happened to JM Equity Fund? Why is it so low?
Sir, JM Equity Fund has not been managed well, sir. There have been a lot of issues with regards to management of the funds. A lot of fund managers moved out of the company. So today, if you see, sir, the JM market share would be hardly probably 1%, 2% of the overall mutual fund industry, sir.
No, if you subtract the the inflation from this, then it will be really negative.
Sir, if you put together everything, sir, we are talking about the last 20 years, 25 years bracket, sir.
Yeah, I'm just looking 10-year
Yeah,
column.
see, these are not percentages, these are multiples, right? So that means 6,700. So Birla's advantage fund, right? So the return is 6,700%.
Yes. So say what we have is like 1 crore was put across in each of the funds, sir. That 1 crore in 26 years has become 67 crores.
Where does your fund stack up amongst these?
Sir, what we have is we do not invest into any of these funds, sir.
I understand, but if you were to position your fund, you know, what would be the 5, 10, 15, 20, 25 years?
Sir, this would be, sir, what we have is the funds that we invest, these funds were not available back then, sir. That is one. Second is, sir, we cannot have a direct comparison because it is not a straight apple to apple because, sir, if you see that the themes of these funds are different, sir.
I understand. So how long has your fund
I think
been
Soumitra, you don't have your own fund, right? You are only using the standard mutual funds which are available. Correct?
Exactly, sir. We are not a fund house company, sir. So we do not have any. Anand Rathi does not run any mutual funds, sir. So
I see. I'm sorry, I didn't get that from the beginning. So the fund that you've been talking about all along is sort of a fund of funds.
No, sir. So these are mutual funds which are run by a separate company, sir. The bigger players in the company, like say an HDFC or an ICICI, an SBI, and Kotak Mahindra. So these fund houses, these run the company. So what we do is like say we come as a filter between you and the fund houses and give you the information that these are the fund houses that has a potential of delivering a consistent returns over a period of time. Also, sir, what we do is we keep a check on these fund houses basis what is the strategy that we follow. So every 6 months we have a call with their CIO and CFO to identify what is the strategy that they are following and it is aligning with our overall strategy or not, sir. So depending upon that, sir, we will move as in few funds or change the portfolio from time to time, sir, or change the allocation depending upon what the market situation is there, sir.
Right. So what exactly is the instrument we would be investing in if we were to go with you? Is it a fund of these funds and
no, sir,
that
these,
keeps
sir,
changing?
No, sir. So these are plain mutual funds. So fund of funds, what we have is fund of fund is like say a fund that you are investing is that particular fund is feeding it to some other fund, sir. So this way, sir, what happens is we incur a more cost and there is no direct control on the strategy, sir. Now compared to that, sir, you are investing directly into a fund that is run exclusively by a fund manager.
This is not a fund of funds, right? So basically it's a portfolio of funds based on your risk profile and based on your return appetite and so on. They will recommend a portfolio of funds and we don't pay any commission to them. They directly, the mutual funds will pay commission to Anand Rathi. So basically the service is free for you from your side. Internally there may be costs. So basically it's a portfolio of funds. It's not a fund of funds.
Okay, got it. So it would be one or more of these funds that they would invest in.
Correct.
Okay.
You can put all your money in one fund or it can be a combination of fund based on their recommendation. So based on your risk appetite and reward appetite, they will recommend something, but ultimately you can choose the funds, right?
Okay, got it. Yeah.
Well, one quick question on that, and then how, if you are being paid by the funds and not basically serving our needs, you pretty much, my concern would be you would recommend the funds that is providing you the biggest percentages out there. So where does our interest come in then?
Sir, a very valid question, sir. Now, sir, what we have is this commission is not paid out to directly in one go, sir. This is given out to the brokers on a monthly basis divided by 12 months. So if you're, say, for example, today, if I go for a fund that has a higher brokerage, so what happens is the fund house, to manage their show, they will deduct that particular brokerage and pay out to the brokers. And overall, sir, your funds will not perform. Now, sir, as we are into a business of making money for you and for us, sir. So the idea is to make money for you. As and when your wealth grows, our commission also will grow in line with that, sir.
No, I think Samitra, his question is different, right?
No, sir,
So let us say that you have 3 funds, right? One, we don't know how much commission you are getting, right? So some fund may be giving you 2% instead of 1%. So his concern is whether you will be recommending those funds, even though the 1% fund may be better for us.
Yeah.
Sir, now, sir,
how do we protect our interests?
No, sir, very much valid, sir. So, sir, what we have is, in this case, all the commission that is paid is in the public domain, sir. So there is nothing that we can hide in. Even if you want to hide, sir, it's not possible, because the commission or this brokerage in the expense ratio is included. What is the standard commission which is paid out? That is one. Second is, sir, our commission is not paid out to us on day one, sir. It is paid out at divided by 12, sir, on a monthly basis. So in case if there is a higher commission, so it will eat away from your principal. Now, in case if it is eating away from your principal, then the performance of the fund will come down, because there is less money which is getting deployed in buying the overall portfolio. So this is where, sir, you can always check from what is the commission that is disclosed, which is there on the website of the company. That is one. Second is the track record of the company also will, and the performance of the company will also justify, sir, whether is there any kind of a hidden agenda behind that disclosed fund, or there's something more to it, sir.
Well, that has been the traditional problem of whose interest are you protecting at that particular time, and where are you getting paid from? Because if you're getting paid from the funds, then basically you have a divided interest out there. So let's continue. Yeah, that's
sir. Once to answer this question, sir, in a more detailed way. So, sir, what we have is once we say take you through in the funds part of it and the portfolio. So that would actually justify a lot of things when we actually talk about numbers on those funds. Now, compared to the other set of funds that has got a higher commission, so that also will tell you, sir, how to identify whether which, but even without you seeing at the disclosed commission, you can identify from those set of numbers is which fund is paying a higher commission, which is not, sir.
How often would we have the opportunity to fine tune this? For example, you find one thing is not going well, right? And then the other one is going well. How often? You said you meet with those guys every year.
Sir, twice in a year, sir. We have a call. So we have a research team which monitors the portfolio on a monthly basis. Is because the fund houses, they declare the portfolio at end of the month or any changes that they bring. We keep monitoring this portfolio on a monthly basis, but we speak to the CFOs and the CIOs on a 6 monthly basis to identify what is the strategy, sir. Because, sir, these mutual fund houses, they deal in a large quantum of money, sir. So in case, let's assume they want to buy Asian Paints today, so they cannot buy 15% of worth of the overall portfolio. They cannot just step in the market and buy 15% in their portfolio of Asian Paints. So they have to buy Asian Paints over a period of time. Otherwise, sir, today demand and supply for Asian Paints will be out of equation altogether, sir.
Yeah.
So we have to give them some time. So we actually discuss more of a strategy basis, sir, what is their outlook and what is the stand that they're taking to create a portfolio. So basis that, sir, if we see that there is no outperformance, sir, one of the things which I would just like to tell you. So recently, sir, we have made few changes in the portfolio. So we have been keeping a track of that portfolio from one of the fund, which is from Axis. So though this is still having a 5-star rating on many of the portals, but the fund was not performing for the last 1 odd year, as in it was just mirroring the benchmark, sir. So we take a conscious call and we have stepped out of that fund and we have brought in a new fund. So we keep on observing the funds on a very regular basis, and if the non-performance continues for a longer time, yes, we would step out of it, sir.
Okay.
Did you say there's a 1% commission on the asset value that we have with you?
Yes. No. So, sir, what happens is this commission is directly related to the fund value, sir. It is not related with the principal. That means today, let's assume somebody has invested, like say, 1 crore today with us. So 1% of this crore is divided by 12 and paid out to us. Now, tomorrow, this 1 crore, 5 years down the line becomes 2 crores, sir. So this 2%, sorry, 1% of this 2 crores is paid out to us on a monthly basis, sir. So
I think 1% is just a hypothetical, right? Because it will vary based on the fund.
No, sir, it is always 1% of the fund value, sir.
Okay, so that is a good point, because every fund is giving you 1% out there. So you will not be biased out there towards one versus the other. That was my biggest concern. That
my understanding is different. I think what he's saying is, let's say we were to keep 1 crore. His commission out of us, in other words, it's going to cost us 1% for his services. Is that right?
No, he's not charging us anything.
No, it's not coming from you. It's coming from them, right? So
wait a minute. Are you charging us anything, or you're not?
No. Sir, there is a cost that exists, yes, but this cost is not directly taken out from the principal today, sir. It is taken out from your from your fund value over a period of 12 months, sir.
No, that's not the point.
But annualized cost is 1%, sir.
Okay, hold on. Whether it's you take it over 12 equal installments once every month, you take it once in a year, doesn't matter, but it costs us 1% for your services. On top of it, there could be some commission that you may be making on the funds that you would be buying on our behalf or into our portfolio.
No, sir.
Is that right?
No, sir. So this is where, sir, there is no kickbacks. There is no mixing of clients' money, our money. There is no other thing apart from this standard brokerage of 1%, sir. So this is where I was saying, sir, the value that we bring in on the table is costing you 1%, sir. But there is no direct, direct fee which is taken out from your principal money. So, sir,
okay, no, hold on.
I thought you said
you understand there is no. It doesn't matter what the principal is. It could have reduced in value because of bad investment you made, or appreciated. Doesn't matter. If 1 crore could have become 75 lakhs, 1% is on that 75 lakhs.
Yes,
right?
absolutely.
Every month you look at the value and it's 1/12 of that month.
Yes,
okay.
yes.
So let's
one more question.
keep that aside.
I'm confused, Soumitra, on that point. I'm confused now. I'm sure many of us are confused.
Exactly. I'm driving. Ari, let me drive the point, and then you'll see it. Okay. There are in US, there are different types of advisors. Okay. But I'm kind of just want to place you one way or the other so you can tell us what it is. Your commission, is it twofold? One is 1% of our total value that we have with you, plus there may be other kickbacks that you may be getting based on the decisions that you would be buying on our behalf?
No, sir.
Or it's just 1% and there is no other kickbacks that you get, no matter which fund you may be investing in. That's where clearly, if you can explain to us, then I think most of the confusion goes away.
Yes, sir.
No, before that, I think he mentioned 1.9% in total. So I think now we are coming down to the one part of the 1.9.
Yes.
So we should talk about the 2%. Let's say 2%, 1%, and there is a MER from the company also.
Yes.
So yeah, keeping their mind not 1% but 2%.
Sir, Haji,
so I'm thinking that could be the cost.
Okay, let Soumitra explain from the. I mean, assume we don't know anything about the fees.
So, sir, what we have is for any fund today in the country, sir, the expense ratio is in the range between 1.25 to 2%, sir. 1.9, 2%, just for discussion's sake, sir. So this 2% includes everything, sir, that the fund incurs cost in terms of paying out salaries to their employees, doing the marketing cost, paying out to the distribution channel, sir. By distribution channel, we mean is paying out to the brokers like us, Anand Rathi in this case, or any other broker through which you are routing the investment, be it a bank like say HDFC Bank or an ICICI Bank. This is one. Now compared to that, sir, what we have is with regards to, sir, we being a mutual fund distributor in the industry, sir. So the regulation, what SEBI has on the mutual fund distribution investment is that we would be paid out our commission on a monthly basis, not in outright commission, sir. And this is directly linked with your fund value, sir. Today, let's assume we start with 1 crore. So 1% divided by 12 is paid out to us month end. Similarly, sir, 1% of whatever the fund value is paid out to on month 2. Similarly, sir, the fund value which is there at the end of the 24-month, 1% divided by 12 is paid out to us. So your money moving up and down, there's a 1% commission will come out, but this 1%, if it comes down, sir, similarly our commission also will come down, sir. So as and when your wealth and our commissions are directly proportional, sir. If your wealth is growing, sir.
So Dharmendra, I think the difference between US and here is that suppose if you engage Merrill Lynch or somebody, right? So they will be deducting from your account 1% every quarter or whatever, right? Like 0.25.
So
but
there is no
here,
additional advisory fee over and above.
they are not deducting from your account. So mutual
No,
fund.
they are. They are.
They
What
are
I'm saying is, it's going to cost you.
Mutual fund.
That's
Mutual
part of
fund
the
provider.
expense mutual fund ratio. If it's 1.9, that 1% is included in that portion that gets
No.
paid to them.
Let me
maybe we let him
say
clarify.
this way. Let's take an example. So we all are clear, because I kind of have one of the advisors doing this to me. That's why I kind of, eventually I moved down. Putnam is very notorious in US for doing that. They pay, there's like let's say there's expense ratio of 2.9% to run their mutual fund. There is a 0.25 or a 0.375 that they pay back the brokers. That's over time, either they pay as an outright money or incentive some other way or to drive the volume, whatever. In this case, if let's say we were to go back there, okay? And 1 crore, let's say we were to invest with them. Every month, 1/12 of 1% of the net value at the end of that month gets deducted. That is for his services.
Yes.
Second is, he may, on the side, every 3 months, every 6 months, whatever the duration that they work it out, either it's Franklin or either it's Putnam equivalent in India, they may have a separate commission structure to pay them on top of our 1%. So if we close our eyes, if we say it doesn't matter what he gets or doesn't get on the side, it's going to cost us 1%. Now, 1% is just for him dealing with us. Then the vehicle, let's just say Franklin India Blue Chip, it has a 2.9 expense ratio. You're paying that 2.9 also on top of that 1%.
No, sir.
Is that right?
No, sir.
Not to you, but as part of the mutual fund.
No, sir. No, sir. Sir, what we have is there are standard declarations, sir, which the fund houses has to declare on a daily basis to the regulator. So whatever the expense ratio that we have is deducted on a daily basis, and after that the NAV is released. So whatever the fund value that one sees, let's assume that they have invested 1 crore.
So effectively 2.9% of expense ratio is, you're paying it, whether it's on a daily basis, proportionately, whatever. That's different, just to be part of that mutual fund.
Yes.
Your 1% is on top of any other expenses that may have for the individual vehicle.
That 1%
I think
is
that's the
included in
difference,
that.
Darmain.
Did I
That's
say
the
it right?
difference. You think of it, it is the expense ratio that he's talking about, which is 1.9%. The mutual fund charges in any case of whatever is the asset value out there. And out of that, they're giving them 1% on an annual basis divided by 12.
No, it wouldn't be.
Yes,
that's what he's saying.
Is
that right?
Sir, that's how it is, sir. So this 1.9% is the expense ratio, sir. Now compared to this, if you see the expense ratio of a direct channel, so you will find that 1% commission is not there, sir.
That's
so Dharmender, you are equating the US operation with this, right? So this is different. So in India, you don't.
No, Nari.
Okay, let me ask one question that should hopefully clarify. Soumitra, if I were to get mutual fund X in the open market, and if I were to get mutual fund X through you, what is the difference in cost I would see?
So, sir, what we have is this 1% would just be knockoff, sir. Say, for example, a regular mutual fund would be costing us 1.9% as an expense ratio, whereas for a direct mutual fund, the same fund, sir, on a direct route, as in you're just buying the mutual fund directly from the company, sir. So that has a 0.9% as an expense ratio.
Got it. So 1% is your management fees, basically.
Yes,
right.
Sir, this is the
over and above any fees charged by the mutual fund, you charge 1% for your services, which, as far as I can see, boils down to managing the money, recommending the funds, and all of that.
Sir, what we have is this is a standard commission which is being paid out. It was very high, sir. Now it is come to 1.9% as on today. So this is so there's a cost that goes towards that the company incurs in developing a lot of sales channels across the country. So those are, we are a wealth management outfit, but sir, the fund houses cannot just run by our mobilization of funds. So there are other channels also that the company develops in this mobilizing of funds. So there is a cost that the company incurs, but they pay a smaller quantum compared to, say, what they pay to us at 1%, sir. But
I'm totally confused. Is
Okay.
this considered expense ratio plus 1%, or the mutual funds expense ratio includes your 1%?
Sir, everything includes, sir, what we have is the upper cap for the expense ratio is 1.9%. It cannot go beyond that, sir. It can at max go to 2%, not go beyond that. That has been a restriction put by the regulator, which is SEBI in this case. That is one. Second, sir, what we have is inside this 1 or 2%, the fund house has to manage everything, sir. Pay their salaries, pay rents, manage the advertisement, manage everything, sir, end to end, including paying the broker's commission.
Which is your 1%.
Which is our 1%, sir, in this case.
Yeah.
Okay,
I mean, Suren's question really clarified it, actually. You know, if you go directly and buy in the market, it will be 0.9. If you go through them, it will be 1.9, because that's what you'll have to pay, the 1%.
Yes.
Correct. Whoever is paying, either the mutual fund is paying them or we are paying them, 1% goes out of your portfolio.
Yes.
Yeah.
Nari, one question which may be common to everybody, at least in Canada, the MER by the mutual fund companies is typically 1.5 to 2.5%. So in his case, the funds he is recommending will have less than 1%, and then top 1%, so that becomes 2%. If it is if the same fund was operating in Canada of equally good quality, it will be about 2.5 or maybe 3.5.
Right. Okay. So that is fine.
But
so,
if
Samitra,
this 1% goes with the, if this 1% goes down, if your investment is higher?
No, sir.
Because there is a proportion also, if the investments are higher, the commission rate goes down to 0.5% and all that.
Sir, on the equity, sir, it is it is 1%, and on the debt, it is 0.5, sir. So this is a standard brokerage, sir, which is paid out to all on the equity side as well as on the debt side, sir.
So it doesn't matter how much you invest.
No, sir, it does not matter on the quantum, sir. If it's a smaller quantum, still that 1%. If it's a higher quantum, still that 1%.
So if we do not want your portfolio management skills and other thing, and we directly go and buy these mutual funds, then we save that 1%, right? So what is the value in going through you?
Sir, this is where, sir, we come in the picture, sir. Now, sir, what we have is, at best today, sir, let's assume somebody would have invested in this Aditya Birla Advantage Fund, just for discussion's sake, sir. So now for him, sir, he will track, say, only the performance, sir, what is there, and he will go, what is the basis of the past return, sir. But the portfolio that the fund manager changes depending upon the outlook, he will take an exposure into XYZ stock. Sir, can I say, close this and take an example of a mutual fund, sir?
Yeah, sure. Yeah, I think this is the last slide, right? Anyway.
Sir, we have 2-3 more, sir. But I'll just, that is important, sir, which I'll just show you, sir.
Nadi, how long more on this call are they, just so that we make sure we can plan?
No, I think we are already over time. So.
Okay.
Sir, this is one of a very old fund in the country, sir, by the name of ICICI Prudential Discovery Fund. Sir, is the screen visible, sir?
Yeah.
So this is a very old fund, sir. Probably, sir, this was started in the year 1999, sir. So this particular fund has been there in the country and it has made good money for people, but it has not made good money for people. I'll just tell you why, sir. So this is a ICICI Prudential Value Discovery Fund, which is based on a theme wherein it will pick up investments from the market or pick up stocks that has a lower, or it is undervalued in the market because of, say, a lower book to value, as in price to earning ratio, or because of some regulatory compliance or some other issue, sir. So currently, sir, we see that there is an outperformance. The blue line represents the performance of the ICICI Value Discovery, and this is the market performance, sir. But when we look at for a longer term, sir, we see that gap closes, sir. So if the fund managers have not changed anything prior to this, it has not done any money on this particular part, sir. So after that, they made the changes. This is where, sir, the performance started coming in, sir.
Right. Okay.
So
basically, we pay that 1% so that they monitor the funds and then they switch the funds and around those sort of things. I think that is the value. You are paying 1% extra than the normal fees of the mutual funds for this service, where they monitor the fund performance and switch funds and so on.
So, sir, on a long-term basis, people have not made money, sir, on this particular fund. But, sir, on a short-term basis, anybody would have just come in now on this, he would have made money, sir.
And the point you raised, actually, Sumitra, was valid, because the more the fund value is, the more money you'll make. So it's in your best interest to keep that growing and not inflating, because you'll get less.
Correct.
Sir, we are in a business of, sir, generating profit, sir. The idea is not to incur losses, sir.
Yeah. Okay. Well, everybody will withdraw their money if you make losses like that. So
not at all, sir.
Okay. So I think we are running over time. Why don't you finish the next couple of slides?
Just I'll quickly finish, sir. Sir, this is a graph. So what we have is, sir, if you look for on a long-term basis from 2001 till 21, the distribution or the returns of Nifty on a long-term average is 12.52% and the standard deviation is 4.13. If I plot the movement of Nifty on a rolling return basis for the last 20 odd years, it will follow a normal distribution curve, sir. Wherein what it says is 50% of the value would be below the average and 50% would be on the higher average. So because of which, sir, we can apply the law of probability and come to a point that there is a 68% probability on a long term that our returns would be between this range, sir, 8.39 to 16.5 at one standard deviation. At two standard deviation, which is a 95% probability that the returns would be in this range, sir, 4.26 to 20.78, and at 3 standard deviation it is 0.13 to 24.19. By this slide, what we are trying to say is, on a long term, sir, people will not lose money in the equity market, sir.
Okay.
Sir, we will discuss more in details with regards to the portfolio construct with reference to the portfolio at a later date, sir. So just I wanted to just show you this particular thing. Is long term, the chances of losing money, sir, is very, very less, sir.
Well, it all depends upon what is long term for someone out there, and what is the timing of their entry. So let's move on. I think we all know that.
Yeah.
Sir, this is a distribution for a 3 years basis, sir. So 3 years, what happens is, because of higher volatility, we would see that the returns, if you plot a similar 3 years graph, that the 65% of the observation is below the average and 34% is above the average, sir. So on 3 years basis, yes, we would see volatility on this, but as this does not follow a normal distribution curve, sir, so the probability law will not come in the picture, sir.
Right.
Yeah, okay.
Makes sense.
Sir, this is the slide. Now, sir, in this, sir, it talks a little bit about the market-linked debenture. Now, sir, what we have with the market, so I'll just go line by line, sir. So with equity mutual funds, sir, with a movement of Nifty of 12 to 14%, it has a return potential of generating 16 to 18%, sir. By getting that higher 3% outperformance, we can come close to that 17, 18%, sir. Then, sir, the next part is a market-linked debentures. So with market-linked debentures, what we mean is that it is linked to the movement of Nifty, but the movement of Nifty required for this particular product to deliver a higher return is very small, sir. So in this case, sir, the movement of Nifty is required is only 6% for the product to deliver a 14% return. Then, sir, we have a lower Nifty as in market-linked debentures that has a 3% movement in Nifty required that has a return potential of generating 12 to 15%. Then the last part is the debt mutual fund that has no relevance on the movement in Nifty, sir. It has a direct correlation with the interest rate cycle that is prevailing, sir. So currently,
so what is the difference? What is the difference between line 2 and line 3?
So line 2 and line 3 is that so say for example, if somebody does not wants a 15-16% return through a market-linked debentures, because through this it will come with a certain movement in Nifty. Now an individual who is only his expectations like say 10-12%, and for him the market as in the Nifty movement would require be only 3%. So it is just directly proportional to the Nifty movement, sir, that would define your output or the return potential. So for a conservative investor,
you're also mentioning that the last line is basically your inflation line. So if you stay on the last line, you're only protecting your capital.
Yes.
Hey.
Sir, for an overseas line, this does not make sense because, sir, there is a currency risk that comes in the
yes,
picture.
in addition,
right.
yeah, in addition.
So, sir, what we have is on a agar aap dekhenge, sir, for the last 5 years, 10 years, if you see the currency, our currency will depreciate by 3.5%, sir, for sure, sir. There is no
More
delay
than
about
that.
it, sir. Like, sir, on a long term, sir, what we have is in years there have been depreciation more, but in years there have been less. So put together on an annualized basis, if you see, sir, for the last 5 years, 7 years, 3.5%, so sir, bare minimum, this is there, sir.
So
Yeah, good
explain
point.
to me a little bit, Soumitra. You know, you said with a target Nifty of 3%, your expected returns are 12 to 13%. Why would someone not do that versus basically increase the risk and go to a medium or something with, you know, very high risk out there?
Sir, what we have is, if you see this line, so what we have is the return, sorry, the upper cap is, say for example, what if the Nifty instead of say 3% movement, it delivered 20% return. So the upper limit is capped, sir, on a market-linked debenture, and vice versa. The downside limit is also capped. Now tomorrow, so let's assume that the market falls by 20%. So we do not suffer the losses of 20%. We would end up not making any losses, sir. So what happens is this market-linked debentures comes as a part of the portfolio, but sir, currently with the bull run that is happening in the market, so we are restricting our exposure into a market-linked debenture only up to 30%, sir, not going beyond that. Because today, sir, the market has a potential of delivering more than say 18% return.